Good evening. My name is Brian D'Amico, and I'm the Manager of Educational Services here at VectorVest. It's my pleasure to present your strategy of the week this evening for Friday, the 6th of September, 2013, titled Protect Thy Capital. The objective of tonight's strategy is to teach you how to protect your gains while still giving you upside potential. In order to do this, we're going to look at using an options trade called a collar. Tonight, I'm going to walk through three things. First, I'll discuss and show why and when you would want to use a collar. Then, I'll demonstrate exactly what a collar is. And third, I'll walk you through how to set up a collar to protect your shares. I'll begin by taking a look at why you would want to place a collar. First off, you'd want to place it to protect your profits. You might have seen a nice run in your positions, and you want a way to protect those profits that you've earned. Second, it provides a low-cost way to buy insurance for your shares. In other words, it provides a low-cost way to protect those hard-earned profits that you have. And third, it allows you to continue to hold your current positions, just in case they do continue to rise. When would you want to place a collar? Well, first, when you do have large unrealized profits. You'd also want to place a collar during periods when there's market uncertainty. The market may have been on a nice run, and now you don't know whether the market will continue to rise or whether the market will begin to fall. And third, after the market has been on that nice run, you should wait at least until you get a primary wave down signal, which we just got today. Or you can wait for an RT kicker down signal. Let's take a look at what I'm talking about in VectorVest. Here we're looking at our market timing graph over the last year, and we're just looking at the price of the VectorVest composite. Over the last few days, the VectorVest composite has moved lower. Now, will this turn into an extended downturn, as it did twice before earlier in the year? Or will the upturn resume, as it did actually a couple of times recently? You see here, after a little pullback, it resumed its uptrend, a little pullback, and it resumed an uptrend. Well, let's look at a couple of things. As we discussed in the timing video tonight, we reached a resistance level recently. And I'll add the support and resistance to the graph here. And you can see here, when price hits this resistance level and it begins to retrace down off of that, it'll typically fall until at least the next support level. Now, if it breaks that, it would typically fall until the next support level. So right now, we're coming down off of a resistance level. Now, we also saw that today we received our first primary wave down signal. So let's look at those on the graph. I'm going to remove support and resistance, and let's put on the primary wave signals. The primary wave is the quickest signal we have. It will be the earliest indication that the market is changing direction and is a great time to consider protecting profits. If you want more confirmation that the market's uptrend has ended, you would use our RT kicker combo signals. So let me add those to the graph. Now you notice in the recent period here, we haven't received an RT kicker down signal yet. However, notice in the past how good those signals were at signaling the beginning of a downturn. You see right here, and right over here, and over here as well. It lets you know that that uptrend has ended, and it's letting you know that there's a downturn beginning. And they've done an incredible job. We also looked at a divergence that we've been seeing between the price of the VectorVest composite and the buy-to-sell ratio recently. So let's remove these kicker signals and move down to 6 months, and let's put the buy-to-sell ratio back on. And if you look here, the price of the VectorVest composite was rising while the buy-to-sell ratio was falling. This was a bearish sign and told us that downside risk outweighed upside potential. So we have indications now that it is time to protect profits. However, we don't have all signals telling us that we're in a downtrend right now. So let's look at a way you can protect your shares while still giving you upside potential. The way we'll do that is with an options trade called a collar. Well, what is a collar? Well, a collar is made up of three components. First, it's made up of a long share position. Second, a protective put. And third, a covered call. Let's take a look at the components of this trade. It all starts with a long share in your portfolio. Obviously, as long as the share price goes up, you make money. And that's illustrated right here. As the price goes up, you're making money dollar for dollar. And as the price goes down, you're losing money. However, if the stock price goes down, you could see losses all the way to zero. So to protect yourself to the downside, you may want to buy a put option. A put option will give you the right to sell your share at an agreed upon price, called a strike price, thus limiting your loss to the downside. In essence, you're buying an insurance policy. However, that put costs something, and it's never fun to have to pay for something. So to help pay for this put, you can sell a call option. By selling a call option, you take on obligations to sell your underlying stock at the agreed upon price if the stock's price rises above the strike price. The good thing about selling the call is it generates cash, which you could use to help buy the put. However, there's always some give and take. By selling the call, notice you also cap your gains. This trade is called a collar. Let's go back into VectorVest. Here we are back in VectorVest, and I've opened us up to the stock viewer. And what I'm going to do is I'm going to sort this by market cap. I'm just going to click on the market cap column and take a look at the shares here at the top. I bet you either own or have owned one of the companies listed here. And if so, you probably have had some gains in your position over the most recent upturn in the market. So let's take a look at the first one in the list here, Commonwealth Bank. To illustrate the trade better, I've built it in our PowerPoint slides. So let's go take a look. Here we're looking at a graph of Commonwealth over the past 6 months. Perhaps you bought it back here when VectorVest first issued an RT kicker up signal on the market. And now you're actually sitting on some nice gains, and you want to protect yourself from drops, such as what you see back here in May and June. You don't want to have that happen again. So to protect yourself from that happening, you could buy a put with a strike price of, let's say, 72, which means that's giving you the right to sell your shares of Commonwealth at $72 a share just in case it does drop. Now I checked what that put is selling for right now, and that put is currently selling for 58 cents a share. So if you buy that 72 strike put, it would cost you 58 cents per share. So you think of that as your insurance policy. Now obviously this insurance policy, like I said, is going to cost you 58 cents a share. To help you pay for that put, you could sell a call option. And let's say you sell your call option up here with a strike price of 74. Selling this call would give you a credit of 60 cents a share. By selling this call, you're left with a net credit of 2 cents per share. In other words, you're getting paid to buy insurance for your shares. Now keep in mind, by selling this call with a strike price of 74, you are taking on obligations to sell your shares of Commonwealth for $74 a share if it does rise above this level. Thus, it would cap your gains here. Now, if you don't like capping your gains at 74, you could always sell a call with a strike price of, let's say, 75. This would allow the stock to go up to 75 before your gains are capped. However, selling the 75 call option would only generate a credit of 30 cents per share, which means your insurance policy would actually cost you 28 cents per share. So like I said, there's some give and take with options. So let's set this trade up in our options analyzer to get a better visual. Here we are back in VectorVest. Now if you don't own the options analyzer, you can get a free 2-week trial to it simply by giving us a call or using the link that we provided in the views tonight. To analyze this collar trade using the options analyzer, I simply right-click on the row for Commonwealth, go to Analyze Options, Bearish, and choose Collar. Here we're in the Options Analyzer, and if you've never seen this tool before, over on the left-hand side it tells you the type of trade we're looking at, tells you some of the details in the upper left-hand corner. To the right it gives you a profit and loss graph, and then down below it's showing you the details of each part of the trade. So in this trade, it's made up of a long position, and in this example, we're just doing a nice even number of 1,000 shares, And then here are the two option legs. The call that we sell and the put that we buy for insurance. Now we need to modify this trade to match our example. So I'm going to come in here and I'm going to click on edit for the short call, which is this is the call that we sold. And I'm going to change the strike price to 74 instead of the 72.51. And I'm going to set the premium to 60 cents. I'm going to click OK. I also need to change this put a little bit, so I'm going to click on edit. I'm going to leave the strike price at 72, but I need to change the premium to 58 and then click OK. Now once I do that, it'll show what the net credit or debit is in the upper left hand corner. So here it shows that we have a net credit of $20. And remember, that $20 is insuring a position that is worth over $70,000 because we have 1,000 shares of a $70 stock. To be exact, the stock price is $73. So we have a $73,000 position. Now keep in mind, if you have 100 shares, instead of doing 10 contracts, you would do 1 contract. But I'm going to leave it as the default here. So by having this collar, it has now made it so that our maximum loss on this trade is only $1,140, whereas before we could have actually lost all $70,000. Also keep in mind that our maximum profit is now capped at $860. So let's do a couple of scenarios here. To keep things simple, we're going to assume that we're at expiration in September. So let's say later on this month, let's say the market rises and Commonwealth does continue to rise. So it's currently at 73. Let's say it does go up to 75. So I'm just going to change this number here to 75. And let's see what would have happened with this position. So the stock went to 75 and I come down here. This is the row for our shares here. And it shows we have a gain of over $1,800 in the shares of Commonwealth. However, keep in mind, if I scroll this over a little bit, we did spend $580 on our put, and the call that we sold is now a liability to us since the share is now above our strike price. So that leaves our net gain at this point at $860. But remember, the reason we entered the collar was to protect our position in case the market and or the share drops. So let's look at that. What if Commonwealth drops to the lows that it reached back a few months ago, which was $65 a share? So let's change this to 65. If we did not have the collar, our position in Commonwealth would be down over $8,000. However, since we do have the collar, the put that we bought has gained in value over $6,000, and we got to keep the full premium from the call that we sold. So instead of being down over $8,000, you're only down $1,100. So overall, this collar, which actually generated $20 for us, saved us from losing an additional $7,000. And by having this collar in place, we're still giving ourselves some upside potential. Now, some of you out there might not trade options. If you don't, I suggest you learn about them a little bit more. Continue to watch some of our Strategy of the Weeks. Now, if you don't trade options, we have had other strategies teaching you other ways that you can protect profits, maximize gains, minimize losses. Let me show you a few of those. Here are some of the recent strategies that we've put together for you, both in the VectorVest Australian product and the VectorVest US product. They teach a variety of ways that you can protect profits, while also showing you ways that you can maximize gains. I recommend that you go back in the VectorVest University and watch some of these videos and learn some of those tips. So let's recap what we did tonight. Tonight we looked at how to protect your gains while still giving you upside potential. We did this using an option trade called a collar, and we looked at how the collar can help you protect your profits, how it's a low-cost way to buy insurance for your shares, and how it allows you to continue to hold your current positions just in case they continue to rise. I'd like to thank you all for attending tonight and hope you have a great weekend.